You're watching a stock chart and you see an aggressive vertical move. Your first instinct is to calculate the acceleration. The asset is rising so fast it triggers an automatic warning in your mind. It's overbought. Trusting the traditional rulebook, you react prescriptively. You short the asset, betting that this level of growth is unsustainable and a drop is inevitable. But the market doesn't follow the rules. Instead of dropping, the price climbs higher for weeks. While your oscillator flatlines at the top of its range, the actual price line continues to break out vertically, liquidating your entire position. This failure stems from a specific cognitive error. You treated a mathematical description of current speed as if it were a direct command to reverse course. To understand why this happens, we have to look at the math behind a momentum oscillator. Strip away the interface, and you're looking at a simple ratio of average recent gains to average recent losses. The formula is constrained within a 0-100 boundary. This creates a structural illusion. Even when the underlying price action is completely unbounded and growing, the line on your chart is forced to look maxed out. When an indicator hits a level like 70 or 80, it is merely reporting a high velocity state. It means upward movement is currently very fast, nothing more. Treating a descriptive speedometer reading as a prescriptive stop sign is a structural mathematical flaw. Strong trends often ignore historical boundaries because they are fueled by macroeconomic shifts. When institutions build conviction, they inject massive amounts of new capital into an asset, overriding the expensive readings on retail charts. Think of trading volume as the physical mass behind that price velocity. High volume is what separates institutional trends from temporary retail speculation. Quantitative trading systems prioritize this volume data. They use it to identify the weight of a move, determining if the current direction is backed by enough force to sustain itself. Empirical evidence supports this hierarchy. This chart showing feature importance in natural gas markets places on-balance volume at the very top. It is a far more reliable predictor of future moves than simple momentum indicators. When institutional volume enters the market, the resulting momentum creates a new reality that simply crushes historical resistance levels. To navigate these environments, quantitative systems apply a specific filter. They determine the sheer strength of the trend before looking at any other signals. This is the average directional index, or ADX. It measures the strength of a trend without caring if it's going up or down. Systems use the 25 level as a filter to identify when a market has shifted from directionless noise into a definitive dominant trend. Inside this high ADX environment, a reading above 70 validates the trend's persistence. It confirms that the movement has significant power behind it. This high ADX state represents a low entropy environment. The price action is highly structured and directional, making it far more predictable than a ranging market. Fading an asset in this low entropy state is a high probability path to liquidation. The structured directional move is statistically likely to override the overbought signals that retail traders use to justify their short positions. Practical success requires a shift in focus. You have to identify the market regime before you ever look at a momentum indicator. This matrix shows why. Left, a ranging high entropy market. Right, a trending low entropy market. Both show the exact same indicator reading. In the ranging market, the overbought boundary signals a valid reversal, but in the trending market, it indicates a steamroller of sustained momentum. The rule is simple. The regime dictates the meaning of the signal. If you don't know the environment, the indicator is useless. Historically, traders craved fixed, universal rules to simplify a chaotic market. There is deep psychological comfort in believing a price level provides absolute safety. But modern algorithmic systems have moved past these arbitrary thresholds. They've proven that no single indicator can be trusted in a vacuum. Fixed levels are an illusion of safety. In a dynamic market, the only way to survive is understanding the momentum and the regime driving it.